Welcome to the Bridge Capital monthly video series entitled Know What You Own. I'm your host, Eric Jefferson, and for this month, we're going to focus on factor-based exchange-traded funds. Now, before we get started, have a few quick words from our legal team. With that, we can go ahead and begin. So I'd like to begin by first defining what is an exchange-traded fund, or ETF. As you can see in the top there, that is a type of investment that trades on a stock exchange. However, it represents ownership in a number of different underlying investments, be it stocks, bonds, or commodities. When we think about some of the key attributes of ETFs, first and foremost, you can see on the left-hand side, diversification. You can own an ETF that has exposure to hundreds, if not at times thousands of individual companies, individual bonds, individual commodities. I sort of describe it like trail mix. You can buy the entire bag of pre-made mix. That's the ETF. That has all of those various underlying components, the nuts, the fruits, the other treats, etc. A way to really give you diversification, reducing that individual stock-specific risk. You also have trading flexibility. ETFs can be bought and sold throughout the course of the day. They trade on a stock exchange similar to most of the big names you are familiar with. Relative to mutual funds, ETFs often come with a lower expense ratio, but the key theme that we want to focus on today, that last bullet point, ETFs, generally speaking, track a benchmark. Now that benchmark can be an index, which represents a collection of stocks like the S&P 500 or the Russell 1000, the Dow Jones. Those are some of the more common indices out there. We're also really starting to see a transition or evolution where indices offering factor-specific exposure have been built, ETF products then designed around them. And that's one key theme we're going to explore in the coming slides. Why is this important? Because at the end of the day, the performance of an ETF is a function of the returns its underlying holdings generate. Those underlying holdings, again, a function of what's included in that benchmark which it tracks. Holdings and performance can be a function of company-specific growth rates or strong or poor management, can be a function of how volatile and how risky some of those names are. A big factor as well comes down to the sector exposure. So the sector simply refers to how that particular company is categorized. You can see there at the bottom a list of the 11 sectors that are used today: financials, real estate, communication, healthcare, consumer staples, utilities, energy, technology, materials, industrials, and consumer discretionary. Now, why do I spend the time to really go through this? Well, as you can see here, represented on the screen is a visual representation of the Russell 1000 sector weights. So if you go back from the end of 2023 to the end of 2016, you can see over time how the various sector weights of that underlying index have evolved. Generally speaking, they are fairly similar at the end of last year where they were 5 years prior. Arguably the slight exception there being the dark red right in the middle. That represents technology. And again, as we've seen, particularly during the COVID era, a lot of those technology companies benefited from some exponentially strong growth. As a result, technology became a larger component of the underlying index. But by and large, if you think about consumer discretionary, if you think about industrials, if you think about energy or communication, those weights over the 5-year period remained fairly consistent, suggesting that although markets ebbed and flowed over that 5-year period, if you simply bought an ETF tied to the Russell 1000, you had a pretty consistent sector exposure from early 2017 through the end of 2023. Now, one of the attributes that makes factor-based ETFs so attractive is their ability to evolve with changing market conditions. On the left-hand side, again, we have that Russell 1000 index, what those respective sector weights were. On the right-hand side, in contrast, we have the Pacer Cash Cows Index. That is the index that, in essence, will go out and that will own the most profitable companies. And will periodically rerun those screens. And so, as a company's profitability either increases or decreases, that will likely be added or removed from the index. That gives investors, again, the opportunity to own the most profitable companies at any given time. Now, two examples I want to draw your attention to. Again, we think about in this 5-year window, going back to COVID, obviously a very difficult, scary time in history. We think about, from an investment standpoint, what really worked. Well, we had healthcare companies, those manufacturers of the vaccines, absolutely printing money. As well, we had a lot of people working from home, no longer spending money on travel. We saw a lot of folks spend money on Amazon. And again, most of what's sold there falls under the consumer discretionary sector category. We look at these Pacer Cash Cows Index composition over time, right at sort of the height of COVID, if you will, started to see a huge boost in those consumer discretionary names and weights. That's represented in pink at the bottom. At the height of COVID, that represented roughly 30% of the index, up from about 10% where it began. That's something that, again, where those companies were incredibly profitable based upon the macro environment at the time. This was an ETF that was able to evolve, adapt, go out and ultimately own those names. Same thing, we see the light brown, if you will, 3 from the top. That represents healthcare going back to late 2016. That was maybe 10% of the Russell 1000 index. You can see for the Pacer Cash Cows, that ballooned to roughly 2.5 times that size, owning a lot of those names, again, that were incredibly profitable based upon some of the vaccines that they were delivering. So we think as markets ebb and flow, certainly different factors, different sectors, different companies will come in and out of favor. We do believe, particularly as we get a little further into this market cycle, that profitability is something that is going to, once again, really, really matter for markets, that the market will reward those companies generating more money relative to less. And this is one area or one way we're able to get exposure to those via a fairly cost-competitive, tax-friendly vehicle. So that's all for this month. Again, want to thank you for taking the time to join us. If you ever have questions or would like to dive into this topic in greater detail, please don't hesitate to reach out. Contact information provided there at the bottom. If you don't connect, have a great rest of the day. Take care.